And welcome back to the Financially Simple Experience. I'm your host, Justin Goodbread. Today we're going to deal with how to use tax brackets to reduce your effective tax rate. Now, last episode we introduced effective tax rate and we talked about how you calculate that. Today I want to take a little different approach. I want to talk about how tax brackets work in the United States. Now, I'm not going to bore you as you're driving down the road with the actual brackets as it speaks, but for the most part, today in the year 2020, before any type of changes from the election that we just transpired we have roughly 7 different brackets, 7 different tax rates. They begin at 10%, then they go to 12%, 22%, 24%, 32%, 35%, and finally the highest bracket at this point is 37%. Now, those seem high, but relative to the history of the United States, those are pretty reasonable taxes. In fact, they're some of the lowest taxes we've ever seen for that high income position. Now, in the United States, we use what's called a progressive taxation system. It's the theory of taxation. There's basically 2 types of tax systems out there. One is called the flat tax. That's what I like. That's what I prefer. So basically, anybody pays roughly 10% of their income, whether they make $100,000 a year or $500 million a year. Whatever it is, you pay 10% of your income. Kind of like a sales tax approach. I like that. I think it equalizes and simplifies the tax code for us, so we don't have to worry about competing with those individuals who can pay people like me to find all the deductions and systems and structures to help minimize taxes. But nonetheless, right now we're not in a flat tax system, and maybe at some point in our country's history we'll be there, but right now we use what's called a progressive taxation system. Under this system, the individuals who make the higher income pay more money. Now, we've heard about that through this 2020 election. It was ad nauseum, depending on what party you lined up with. You have some that feel like as the saying says, the rich don't pay their fair share. I disagree with that statement philosophically, mathematically, and a number of other reasons. But nonetheless, the progressive tax system says those who make more pay more. So let's go back to our example. Somebody making $100,000 a year might pay 20%, but somebody making $10 million or $50 million or $400 million a year in income may pay 40, 50, 60% of their income. So it's called a progressive tax system. Now, in practice, typically it uses a hybrid between what's called a flat system and a progressive. So, for example, in the United States, what we have is we've come up with a system of brackets. That's a hybrid between the 2 of those. So we have brackets that come in. I want you to think about as you're driving down the road or as you're watching this on YouTube even, I want you to think about climbing a ladder, if you will. Think about the rungs or the areas that you put your feet and your hands on a ladder. As you climb the ladder, the taxation gets greater. So at the bottom of the ladder, we may deal with a system like in the United States for an unmarried or a single individual, unmarried individual. The very first rung of the ladder is from zero amount of income to $9,700. You pay 10% tax on that. There's a flat tax for that portion. Now, between $9,701, that dollar over, and $39,475, you pay 12%. And then between $39,476 to $84,200, you pay 22%. So those are the rungs on the ladder I was speaking about. You can actually move from 10% to 12% to 22%. So that means in 2019, as you go through these, you're going to pay various rates. Now, don't misunderstand what I'm trying to say. Just because you're making $80,000, let's say, and you're in the 22% bracket, it doesn't mean that you're going to pay 22% on your full income. That's not how it works. It's progressive taxation. So that means that from zero to $9,700 as a single individual in the United States, you're going to pay roughly $970 in taxes on that portion. Then from $9,701 to $39,475, you're going to pay 12% on that, which that is $3,573. And then from $30,476 up to the next number, you're going to end up somewhere in the neighborhood of $2,000. So if we're looking at $50,000 in income for a single individual, you're going to pay roughly $6,858. That's a rough math. If you calculate that back, let's go back to our marginal tax rate. Our effective tax rate. We take 6,858 divided by 50,000, and just over 10% there. Not much. You're not paying the full 22%. So as you climb the ladder in your income, that rung, and only that rung on the ladder, pays more taxes. It's a moving bracket. It's called a progressive system that also incorporates in some flat tax into it. So what do we do with all this? Well, you have to know where you lie in your income and your brackets, and it matters. Now, Jeff in our office, Jeff's a CFP, works alongside with me day in, day out. We work together. He said, Justin, I just think you don't make a big deal out of it. We were talking about the brackets. He said, you're not talking much more money. So underneath the current bracket, let's go to married, filing jointly. You have brackets that look like 10%, 12%, 22%. That's a pretty big jump, right? That's a 10% jump. 24%, 32%, 8% jump, 35%, 37%. And each of those have different calculations on where they're at. So, for example, underneath today's system in the United States in 2020, before any type of changes come from the outcome of the election, once you're over $622,000, you start paying 37%. But you can make between $414 and $622, and that's at 35% taxation. Whereas if you're all the way down at $19,750, you pay 10%. So there's your rungs there on the ladder. But it matters. It matters. Here's why it matters. Because you have to deal with phase outs. You have to deal with certain phase outs. I'm going to give you two as an example and then one major, because we're not going to have time to dive into all these, but I want to give you an example.
Owning a business is one of the most difficult things we can do. At some point, we've all considered hanging up and selling, but is the saleable value of your business what you think it is? Heritage Business Advisors can help you to maximize your business's value through targeted value growth and exit planning. To learn more, visit heritagebusinessadvisors.com.
So let's deal with just the basics. Let's just start with the basics. Let's deal with Roth IRAs. Roth IRAs, if your adjusted gross income as a married couple goes above $206,000, you're not able to make a contribution to your Roth IRA. If you're a single individual and it's greater than, if it's greater than $139,000, then you're limited on your Roth IRA contributions. That matters. Okay, well, let's talk about traditional IRAs. You realize that you lose phase out of deductibilities. In other words, you can put money into an IRA and you start losing the phase out. So at $124,000 on a married couple, you're completely phased out where you can no longer get deductibilities on your IRAs. Now there's some caveats, but that's the most part. Think about this one. Let's talk about capital gains. Do you realize in the United States, if you make less than a married couple, make less than $80,000 on a joint return, your tax rate is zero for capital gains, for long-term capital gains? If you make less than $80,000. Now, if you're single, if you make less than $40,000, then you have a 0% tax rate. That matters. So if all of a sudden we're looking and we're made $86,000, we're $6,000 over that, and you happen to have a pretty sizable capital gain, which is included in that, then phase outs are going to matter, and so will your bracket. So we got to figure out how to reduce that bracket. Now, as business owners, the one that I often see people forget is the qualified business income deduction. Qualified, we call it the QBID as short, QBID. What is it? Well, if you make less than $157,500 single or $315,000 married, filing jointly, then you don't have to worry about what type of business you have, and you get the 20% deduction. Okay, that's the cool part. There's some qualified businesses and all this stuff. I don't have time to get in that today on the episode. You can go back and read some of the past podcasts, or talk to your tax advisor, or reach out to us, and we'll be more than happy to help you with that. And while we're talking about that, let's hear a word from today's sponsor.
Our current business climate is a hostile one that challenges business owners with new obstacles every day. Whether you need to improve operations, sales processes, or anything in between, Heritage Business Advisors has helped hundreds of business owners just like you create working solutions for the problems that running a business can present. Learn more at heritagebusinessadvisors.com.
So we're talking about phase outs, we're talking about deductions, and we're talking about brackets. So some people say that the brackets don't matter when they do at certain points. For us business owners, one of the things we have to be aware of is the CUBA deduction. So 20%, it's 20% deduction on our business. And depending on what type of business you have, if you make less than $350,000 married filing jointly, then you don't have to worry about the business. So let's just say hypothetically here that your adjusted gross income was $370,000 and you're $55,000 over the CUBA allotment. You can believe that there's a way to reduce that amount of money. You can believe there's a way to get that 20% deduction on that. It's not insignificant. See, whenever you're dealing with a business and you make less than $315,000 as a married individual, there's no limit on the deduction. But if you're between $315,000 and $415,000, then you're going to be limited. And if you're north of $415,000 in total income on certain businesses, then there is no deduction. There is no CUBA deduction available. What happens if you were at $416,000? There's no deductions available. You better figure out a way how to drop your bracket or drop your adjusted gross income down. So bracketing matters. Tax brackets matter because they're going to come into certain calculations. Number one, you have your taxes that are going to be calculated from the bracket. Number two, you may have taxes and certain deductions based on where the phase outs, where the brackets all come together, where you could actually end up reducing your taxes plus getting some additional depreciation. How do you do it? Well, there's the age-old question. Here's the way that my checklist at year end. And this is not exhaustive. Go back and listen to Mr. Chris Mahan's podcast that we released not too long ago. He did a very good job on going through it. But here's the planner's mindset on things that you can do. These are pretty simple. You can contribute to your HSA. That'll help reduce your adjusted gross income. You can contribute to your 401ks. That will help reduce your adjusted gross income. Depending on where you're at, you may be able to get traditional IRAs involved. You can profit share. Profit sharing will often reduce your business income, thus maybe helping you qualify for CUBA, for example. You can use cash balance plans, one of the plans that I love to utilize with business owner clients. You can pay some expenses. Maybe you want to pay 2 or 3 extra months rent in December for January, February, and March, and that expense will help you reduce your total income by increasing your expenses. You may end up buying a piece of equipment, so to speak. You may go out and buy that bulldozer or that backhoe that you've been needing, or that copier, those computers. Or one of the things that I'm actually looking at is because we write our own music, I was looking at a keyboard to write music on for us to use in our podcast. And this would be a great sound feature that we could use. You may want to look at something that you can utilize in your business strategically and purchase it. There's a number of ways, nonetheless, to reduce your income. And by reducing it, let's just say, just by happenstance, that you were just over a 35% tax bracket. Yeah, it's not going to matter much, but it may change your effective tax rate. So tax brackets matter. They do matter, in my opinion. Some people would argue they don't, but they do matter. And if you understand where the brackets work and you understand how deductibility and tax planning works, then you can reduce your effective tax rate. So friends, I hope this gives you some insight into thinking as a business planner, thinking as a business owner. If you don't know how to do this, reach out to us. We do this every single day of the week. We work with tax advisors nationally. As planners, we have all sorts of ideas. Some they like, some they don't like. But we know how to do this. You need help, reach out to it. Look, I realize life is hard. I get it. Life is hard, but life is good. Life is good. It's amazing. And life can be frustrating. It doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.